Imagine being able to predict market movements using nothing but data, math, and a machine. No gut feelings, no guesswork, just cold, calculated precision. That's the world of quantitative finance, where financial power meets mathematical mastery. In a world flooded with volatility, where headlines shake markets and emotions cloud judgment, quants rise above the noise. They don't just invest, they engineer success. And here's the kicker. You don't need to be born a genius to enter this world. You just need the right mindset, the right tools, and the willingness to learn. Welcome to the Cash Chapter, where today we'll unlock the future of wealth, one equation at a time. Quantitative finance isn't just a buzzword. It's how the world's top hedge funds, banks, and trading firms dominate the market today. Firms like Renaissance Technologies and Two Sigma don't rely on CNBC analysts or crystal balls. They use teams of mathematicians, programmers, and data scientists, known as quants, to build models that detect patterns invisible to the human eye. These models can run thousands of simulations, backtest ideas over decades of data, and execute trades in milliseconds. It's not just smart money, it's super intelligent money. Now let's bring this down to earth. You're probably thinking, this sounds elite. Do I need a PhD in physics or work at NASA to become a quant? The answer? Number. Yes, the field is technical, but the doors are opening wider than ever. Free tools like Khan Academy, Coursera, and YouTube itself can teach you linear algebra, statistics, and coding in Python. The building blocks of quant finance. Combine that with free market data and open source platforms like Quant Connect or Backtrader, and you've got everything you need to start building your first trading model from your bedroom. But here's the twist most people miss. Quantitative finance isn't just about trading stocks faster. It's about thinking differently. It's about understanding that markets aren't random. They're full of repeating behaviors, driven by emotion, news, algorithms, and chaos. Quants use probability, machine learning, and optimization to cut through that chaos. And in doing so, they don't just make money, they design it. And yes, the money is real. Entry-level quants at hedge funds or banks can make $150,000 to $250,000 per year. And with a few years of experience, that number can hit 7 figures. That's not hype. That's Wall Street's new reality. But here's the best part. While most people are still stuck trying to guess which stock to buy, quants are building systems that adapt, learn, and grow, even while they sleep. Now let's talk about the day in the life of a quant, because this is where the magic becomes real. Picture this. You clock in at a sleek financial firm or even work remotely. The first part of your day might be spent analyzing last night's market data using Python, tweaking your model's risk tolerance, or testing how your algorithm would have performed during the 2008 crash or the COVID dip. Then maybe you meet with your team, another group of sharp minds running simulations, optimizing portfolios, or brainstorming ways to reduce milliseconds off trade execution time. This isn't some abstract job where you sit in meetings all day. It's hands-on, high stakes, and intellectually thrilling. And if corporate life isn't your dream, here's the kicker. You don't have to work for a firm. Many modern quants are independent traders, building and selling models, or running their own automated portfolios using platforms like MetaTrader, Quant Connect, or interactive brokers. Some create passive income streams by selling signals or licenses. That's the power of data. Once you build a winning system, it can scale without you. You stop trading time for money and start trading logic for leverage. Now you might still be wondering, but where do I even begin? Here's a roadmap. First, build your foundation. Focus on probability, statistics, and linear algebra. These form the core of any financial model. Second, master Python, the most used language in quant finance today. Then start playing with real market data. Sites like Yahoo Finance, Quandl, and FRED offer free data sets you can use to test ideas. From there, join communities like Quantopians forums, r/quant, or even Discord groups where aspiring quants share tips, code, and feedback. It's not about having all the answers. It's about building in public, failing forward, and staying curious. And remember, you're not late to the party. You're actually early. While the world is distracted chasing meme stocks and crypto hype, the real wealth is being built quietly by those who understand the language of markets, mathematics, logic, and code. That's your edge. That's the quant advantage. To truly grasp the power of quantitative finance, let's step into the shoes of one of the most legendary quants of all time, Jim Simons, founder of Renaissance Technologies. He wasn't a Wall Street banker. He was a mathematician and codebreaker, but he cracked the market using pure data and math. His fund, Medallion, averaged over 66% annual returns for decades. That's not luck, that's quant. And the most incredible part? His models don't care about what's on the news, who's tweeting, or what emotion is swirling through the market. They just run, they analyze, and they win. Here's another example, volatility trading. Most retail investors fear market volatility. They panic during crashes. Quants, they thrive on it. Using models like the GARCH model or Black Skulls, they can anticipate volatility spikes and profit from them. Some even develop strategies that don't rely on picking winners or losers. They profit from the mere movement of prices, regardless of direction. It's like making money from turbulence instead of smooth sailing. Let's also talk about the types of quants, because this field is more diverse than most people realize. There are quant traders, the algorithmic warriors executing thousands of trades per second. There are quant developers who build the infrastructure behind those trades. There are risk quants who use models to predict financial catastrophes before they happen. And there are research quants diving deep into financial theory, discovering patterns no one else sees. Each role plays a part in the high-speed, data-driven machine that is modern finance. And guess what? You don't have to work at a hedge fund to benefit from this. If you're building your own portfolio, even if it's just a few $100s, you can apply quant thinking. Use sharp ratios to evaluate risk-adjusted returns. Use correlation matrices to build diversified portfolios. Use Monte Carlo simulations to forecast your financial future under thousands of market scenarios. This isn't Wall Street wizardry. This is real-world personal finance, upgraded. Let's also not forget the rise of machine learning in finance. With tools like TensorFlow, Scikit-learn, and XGBoost, you can now train models to detect nonlinear relationships in market data, patterns the human brain could never spot. Imagine feeding your algorithm years of historical stock prices, earnings reports, sentiment data, even tweets, and watching it predict future moves with eerie accuracy. It's happening, and it's only the beginning. Now here's where motivation hits hard. The biggest myth in investing is that you need luck or insider info, but quantitative finance shatters that myth. It says if you can learn math, write code, and stay curious, the market is yours to model. Every data point is a clue. Every fluctuation is feedback. Every failed trade is a lesson, not a loss. And that's the mindset we're building here on the Cash Chapter. In the next segment, I'll show you a sample quant strategy you can start building today, even as a complete beginner. But before we dive in, hit that like button, drop a comment telling us your math or coding experience, and subscribe if you want to build wealth with logic, not luck. Great. Let's dive into a sample quant strategy that you can start building today. Even as a complete beginner, this will give you a concrete example of how quantitative finance works and how you can use data-driven decisions to shape your financial future. All right, here's a simple yet powerful mean reversion strategy you can apply to stocks or ETFs, even if you don't have access to Wall Street level data. Mean reversion is the concept that prices tend to move back towards their average over time. When a stock or asset becomes overbought or oversold, it often returns to its mean price. Step 1. Data collection. First, you'll need data. Don't worry, you don't need to spend thousands of dollars. Yahoo Finance, Google Finance, and Alpha Vantage offer free data for hundreds of stocks. Download the daily closing prices for your chosen stock over the last 6 months. Step 2. Calculate the moving average. Next, calculate the simple moving average, SMA, for the stock. This is the average of the stock's price over a set period. For example, let's use a 20-day moving average. If the current price is significantly higher than the 20-day SMA, it could signal an overbought condition, suggesting it might fall. If the price is lower, it could signal an oversold condition, meaning it might rise. Step 3. Calculate the standard deviation. The standard deviation measures how spread out the stock's prices are. A higher standard deviation indicates more volatility. You can calculate the 20-day rolling standard deviation of the stock's price. This gives you an idea of the normal range of price movement. Step 4. The trading strategy. Here's the core of the strategy. Buy the stock when its price falls 2 standard deviations below the 20-day moving average. Sell or short the stock when its price rises 2 standard deviations above the moving average. This strategy is rooted in the belief that the stock's price will eventually revert to its average. If the price is unusually high, it will likely fall back. And if it's unusually low, it will likely rise. Step 5. Back testing. Now here's where you can test the power of this strategy. Many free platforms like Quant, Backtrader, and even Excel allow you to backtest your strategy using historical data. By running the strategy through past data, you can see how it would have performed over the last few months or even years. Step 6. Automation. Once you've tested your strategy and you're comfortable with it, you can automate your trades. This can be done with platforms like Interactive Brokers or Alpaca, where you can write Python code to execute buy-sell orders based on your algorithm signals. And that's it. You've just created your very first quantitative trading strategy. As you get more comfortable, you can layer in additional factors like momentum, volume, or sentiment data from sources like Twitter or financial news, and use machine learning to refine your model. Now remember, this is just the tip of the iceberg. In quant finance, the most successful strategies aren't always the most obvious. Sometimes it's the ability to see the market's underlying patterns, the ones that most people miss, that leads to massive returns. That's what being a quant is all about. Developing an edge through understanding, logic, and, of course, data. Keep in mind that each step you take towards learning quantitative finance is a step closer to becoming part of the next generation of market disruptors. And there you have it. You've just taken your first steps into the exciting world of quantitative finance. The beauty of this field is that anyone with curiosity, the right tools, and a bit of perseverance can dive in. Whether you're looking to build your own trading strategy, enhance your personal investments, or even pursue a quant career, the possibilities are endless. But here's the key takeaway. It's not about waiting for the perfect market conditions. It's about using data, math, and logic to build an edge. The models don't lie. Your results don't depend on luck. The more you practice, the more refined your strategies become, and soon you'll find yourself making decisions based on cold, hard data instead of emotions or guesswork. So what's next? Start building your knowledge, master coding, get familiar with the math, and start creating. There's no better time than now to tap into this powerful, data-driven world. If you're feeling a bit overwhelmed, don't worry. Just take it one step at a time. Start simple and build on your knowledge as you go. If you found this video useful, drop a like, leave a comment below sharing your thoughts, or let us know what area of quant finance you want to dive into next. Don't forget to subscribe to the Cash Chapter, where we'll continue to break down complex financial concepts into easy-to-digest, actionable steps. Keep pushing forward, keep learning, and remember, you're building your financial future with logic, not luck. Thanks for watching, and until next time, keep quantifying your success.